So the word is Time Warner Cable, a $37 billion cable TV company, is in play. One of the suitors is supposed to be Charter Communications, a smaller company trying to borrow maybe $25 billion to help it buy Time Warner Cable. Jeff, you've been looking at this idea of turning the tables, what they call the Pac-Man
we just kind of
effect.
think, I mean, we just had it happen with Men's Warehouse, so we kind of thought, well, maybe it would work in this situation too.
In other words, the bigger company buys the smaller one.
Exactly, because what would happen is that you would wind up with a lot less debt because it's buying a smaller company. So even if they were to borrow some money, it would be a less indebted company, but you keep all the benefits of the deal. Like and there are a lot of cost cutting available, particularly with programming costs and normal administrative stuff with putting companies like this together.
Okay, so you've already had a run up in actually both companies' share price, but including Time Warner Cable.
Yeah.
The problem with this is usually if you're a target, your shares are going to go up, and then if you turn acquirer, they could go down. But you've kind of been running the numbers on this. It's not quite as simple as that.
Right. What was interesting in this case was that John Malone came in and bought a minority stake in Charter in March. And both stocks have gone up almost identically 40-some-odd% since then, in the expectation of a deal and these synergies that we've been talking about.
So the question we wanted to answer with this Pac-Man thing was, could it be more worth Time Warner's while to buy Charter than the other way around?
And that's if you take a look here, what we started out with was this idea is, because the stock has run up so much, we say, assume that they don't pay any premium. There's already a big premium built into the stock. Maybe they fund half the deal with stock, half with debt. You assume sort of over $1 billion worth of synergies, and you put the combined company on a multiple of 7.5, and you see what you get is a nice little premium to Time Warner.
So the current share price is 130. This might be worth 13% more if Time Warner Cable were to buy. So I don't know. I mean, my first question would be, well, why no premium? I mean, you said they'd ramped up, but normally you have to pay a premium. So, but people can play with this.
Yeah, I mean, you could assume. Let's assume that there is a 15% premium instead of 0%, and then you might even assume right now, because of all this, that both stocks are trading at higher than 8 times EBITDA. So you can assume that it's at 8 times. Maybe it goes to 8. And you see, even in that scenario, you get an even higher premium.
Right, if you think the multiple is going to be higher, the premium goes up pretty
Right, and you can play with all these numbers to try and figure out, what it works. I mean, one thing it does tell you is there are some other factors that you would want to think about, not just the financials if Time Warner Cable were to buy Charter.
Right.
But at the very least, even if Time Warner Cable didn't want to turn the tables, what this can try and show you is what the value is for Time Warner Cable, which right now the stock is trading around 130. Right. Maybe it means, based on this, that Charter's going to have to pay up if it really wants to, go ahead with its deal.
Okay, thanks, Jeff. We'll leave it there. You can find our calculator at breakingviews.com, and we'll be back with more Breaking Views tomorrow.